This is a closed-door session that's taking place today in Germany, but nevertheless, central banks around the world, and Mario Draghi is no exception to this, is signalling very clearly we are beginning to reach some of the limits of what monetary policy can achieve. You've talked in the past, I heard you at the Handelsblatt conference, saying the world needs to wake up and say monetary policy isn't working right now. They're signalling to lawmakers, they're signalling to governments, you have to do something here, you have to pick up the baton. My question is, do you think governments are listening?
Well, I think that the problem has two dimensions. The first one is central banks have taken, unprecedented action, and we moved in many countries to what I call a corner solution, where monetary policy carries all the weight of policy, and where fiscal and structural policies have been taking the back seat. To some degree, it's central banks' own fault that situation unfolded, because I think by moving early and moving fast and moving very bold, they signaled to other politicians that they can take their time to put these policies in place. A good paradigm for that is Abenomics, which has 3 arrows. If you look at the third arrow, which is structural reforms, for that to fly, it takes much longer. So you need to fire it first. It shouldn't be the third arrow, it should be the first. And what central banks can do is they can bridge that time till structural policies and fiscal policies that need to go through Parliament, that takes time to decide and to implement, are working. Here, what we've seen is just the opposite. Central banks moved fast and bold, and the other players relaxed and sat back. I think the issue where Mario Draghi faces the European Parliament or the German Parliament is more about transparency on what they're doing. It's not about really a wake-up call to parliamentarians. I think what central banks need to do, because they're outside of parliamentary control, they need to explain to the other part what they're doing. And I think that is a good and I think worthwhile exercise. But in general, central banks need to ask themselves, have we really not done too much, and have we really not produced incentives for others to take the back seat? And I think there is some truth in that.
Has QE only favoured the 1%? And if so, what are the political implications of that?
Look, Mario Draghi has been very clear when he talked about that in front of the European Parliament. Yes, it does have redistributive effects. And if you look at the general policies that we've seen, depressing yields on fixed income and safe assets and driving people and investors into riskier assets, which is what this policy does, favors those that have the risk-bearing capacity and the ability to control the risk about buying riskier assets. That's not your average man on the street. These are sophisticated investors, these are institutional investors. So to some degree, there has been this redistribution that if you're willing and able to take risk, and if you can bear any losses associated with that in an adverse scenario, you have benefited from the current environment. And if you're looking for safety, like pension funds that have it in their mandate to look for safety, you actually were not doing well. So in a way, there is redistribution. I think the more affluent part of our societies have seen their assets and the value of their wealth go up, where the average part of society has seen an erosion in their pension entitlements, and that has really been continuing to bifurcate our societies. And it's one of the discussions we have in the American election. It'll come up in the European election. These redistributive policies are usually not the core remit of a central bank. Central banks are supposed to do more neutral policies and to focus on preventing inflation, to ignite inflation and to intervene massively in markets. To do that has been a new policy paradigm, and I think it does have its downside effects. My guess is at the moment, the downside, the risks of these policies are starting to outweigh the benefits that these policies had in stabilizing the system. And medium to long term, there are huge financial stability risks associated with that. It's not that the central banks don't see that. They have clearly communicated that, but they're coming to a point where they have to really do a sober risk assessment of whether more of the same is going to fix the issue, given the fact that it hasn't fixed the problem for 8 years going.
Mr. Weber, last time we heard from Mario Draghi at the ECB meeting, he said to banks, stop blaming me. Your net interest margins are actually stable. The negative rates aren't hurting your profits. Do you agree with him?
Well, I think central banks have, as I said, embarked on chasing an inflation target that is increasingly difficult to achieve. If you just look at the Bank of Japan, where they've invented a new set of policies, and I think that is going to continue, central banks will continue to invent new policy tools, but they haven't really achieved the objectives they set themselves. In the past, I remember at the Bundesbank, the bank used to talk about an unavoidable inflation, and they tried to control inflation on top of what was unavoidable. Now I think central banks have to start a debate again on achievable inflation. and trying to aim for inflation targets that are simply unachievable and are equal to just massive continued stimulus for a long, long period of time, in my view, is not conducive to their credibility. And if you continuously miss your target, you lose credibility in the market, and central banks need to have that credibility to guide the market. Look at the US. There is a debate where the market expects a very lower trajectory for the Fed funds rate than the Fed itself has announced. And the market's view is the Fed will come around to the market view. So the market players think that the Fed is having to change their policy because their judgment on the interest trajectory is too optimistic and assumes an ability to tighten earlier than the market sees. That's not a good place to be in for central banks because it undermines their credibility, it impacts their ability to guide the markets, and that's the core of what central banks need to do, so they need to regain that credibility. And a dialogue with parliamentarians, as we're seeing today in Germany, is part of that process, but it will not do it alone.
Investors
and
are
how much is it
increasingly...
eroding your own...
Sorry, Caroline.
Apologies. How much is it actually eroding your own business model at the moment, though? The negative rates, should the ECB step back from negative rates to support the banks?
Well, see, it impacts on various business models of the bank. We have a diversified business model, both in terms of the businesses we're in. Our choice is that we want to be excellent in the business we're doing. We're the #1 global wealth manager. But of course, if your clients are cautious about investing and have a large proportion of their portfolios in cash, it is impacting on the profitability even of wealth management and asset management business. At the same time, negative short-term interest rate and a flat yield curve that is negative for long periods of time, for long maturities, really makes it very hard for the bread and butter business of credit origination and taking deposits, short-term deposits, and turning them into long-term credit engagements is very unprofitable as well, because you're talking about maturity transformation not working anymore. So every part of a business model of a bank is impacted by the current environment of negative yields, of flat yield curves, and of a sort of massive intervention of central banks in the market that buy some of the assets that in the past have really been bought by other players, and so they're depressing yields even in those segments where they're active. A very difficult environment.
Okay, let's just kind of feed off that a little bit. The big liquidity story at the moment is that everybody has it as their #1 priority. Liquidity is everything. People are being forced into illiquid assets. They're having to barbell their portfolios in order to do that, so they're running a big cash position over here while they're running illiquid positions over here. Kind of, how does that end? How do you work your way out from that? Because they're buying into assets that have got 7, 10, 15-year lifespans. We're locking in an awful lot right now. Absolutely, and just to give you an example, on the day of Brexit, the longest running Swiss government bond, which had a maturity date of 2064 on it, was dipping into negative territory. So you could choose along the entire yield curve of 48 years whether you want to lock in a short-term loss, a higher loss for a short period of time, or a smaller loss for a longer period of time. That's a very unfortunate choice for investors that need to buy secure assets because they basically run a pension fund or they look after investors' money. So it's a very unfortunate situation. In the long term, I think central banks will have to step back from these massive interventions in the market because there's not a single price of a single asset in the market that is not distorted by these actions. And the only way that at the moment investors are trying to pick some yield is by moving from traded assets into not so frequently traded assets. So they're basically trying to secure a illiquidity premium, or they're trying to tie down money in private equity for longer periods of time, because on traded assets, the yields are suppressed, years out. So a very difficult environment. And of course, the issue is, as some of those risks materialize when the economy normalizes and interest rates start rising again at some point, you can lock in losses over a long period of time. So investors, in my view, still do the right thing in buying risky assets because they are understanding that the central banks will keep the current set of policies in place for a longer period of time. But this is an artificial support for equity. It is not a fundamental based on earning capacity rally in the equity market. It is a liquidity-driven investment. And as soon as liquidity on the horizon starts to change, like when the Fed changes policy, people move out of these engagements, and that's where you see some sell down in the market and a market correction. So
very volatile times, sometimes a single day movement in the stock market is larger, way larger than the annual expected return you have. So that's a situation where you can lose or win on a single day more than the average expected return on the market. And that's a very unusual and difficult situation to manage.
It's been a great pleasure seeing you this morning. Thank you very much indeed for taking some
Guy.
time this morning here on Sept. You're going to carry on with us. Axel Weber, the chairman of UBS, joining us exclusively here on Sept.